Hello and welcome again. This is your host Harshit Simha will present then last episode of the Part series of SEBI Master Circular on LODR compliance, the 30th of January 2026 that covers Chapter 6, Other Obligations and Disclosure Requirements under the Securities and Exchange Board of India, SEBI, Master Circular on Listing Obligations and Disclosure Requirements, LODR, dated the 30th of January 2026. Consolidates critical governance, transparency, and compliance mandates applicable to listed entities. This chapter serves as a comprehensive framework to ensure continuous and timely dissemination of material information, thereby strengthening investor confidence and market integrity. It encompasses a broad spectrum of obligations, including maintenance of functional websites, publication of policies and financial information, and prompt disclosure of events or information that may materially affect the performance or decision-making of investors. Listed entities are required to adhere to structured timelines and formats for disclosures, thereby promoting uniformity, comparability, and accountability across the securities market. The provisions also emphasize the need for robust internal controls, effective monitoring mechanisms, and clear delineation of roles and responsibilities among key managerial personnel. Further, the chapter mandates disclosures relating to shareholding patterns, corporate governance practices, related party transactions, and compliance with regulatory directions issued from time to time. By integrating technology-driven reporting and digital dissemination, SEBI seeks to enhance accessibility and transparency. Overall, Chapter 6 reflects SEBI's evolving regulatory philosophy, focusing on proactive compliance, ethical conduct, and sustainable corporate governance in alignment with global best practices and stakeholder expectations. Slide 2. Minimum Public Shareholding Requirements, Method and Dematerialization. The Minimum Public Shareholding (MPS) requirements under the SEBI Master Circular on LODR compliance, dated the 30th of January 2026, reaffirm the regulatory obligation of listed entities to maintain at least 25% public shareholding in accordance with Rule 19A of the Securities Contracts, Regulation, Rules 1957 and Regulation 38 of the LODR framework. These provisions are designed to enhance liquidity, ensure fair price discovery, and promote wider investor participation. To achieve sustained compliance, the circular prescribes a structured and sequential approach. At the first stage, listed entities are required to conduct periodic review of their shareholding structure, assessing whether public shareholding has fallen below the prescribed threshold due to corporate actions, promoter acquisitions, or market developments. This review must be supported by accurate data and internal governance mechanisms. Subsequently, the entity must select an appropriate method from SEBI-approved mechanisms, taking into account market conditions, investor appetite, and regulatory timelines. The chosen strategy should align with the company's capital structure and long-term governance objectives. The third phase involves execution of the compliance plan, ensuring timely disclosures, regulatory filings, and transparent communication with stakeholders. Finally, companies must monitor compliance on an ongoing basis, track progress, and submit periodic updates to stock exchanges, thereby reinforcing accountability, transparency, and adherence to the spirit of good corporate governance. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes a structured framework of methods for achieving minimum public shareholding (MPS) compliance, categorized in two categories: market mechanisms to provide flexibility while ensuring transparency and market integrity. Under the primary market methods, listed entities may enhance public shareholding through fresh issuance of securities to the public via prospectus, thereby broadening the investor base. Additionally, companies may undertake rights issues specifically targeted at public shareholders, institutional placements, or qualified institutions placement (KEEP), to increase non-promoter holdings in an efficient and time-bound manner. These mechanisms facilitate capital infusion while simultaneously supporting compliance objectives. The secondary market methods focus on dilution of promoter shareholding. Promoters may undertake offer for sale (OFS) through stock exchanges, enabling transparent price discovery. Furthermore, promoters are permitted to sell shares in the open market, subject to regulatory limits of up to 2% annually or 5% cumulatively, thereby ensuring gradual and orderly dilution. Transfer of promoter holdings to exchange-traded funds, ETFs, is also recognized as a compliant route. Collectively, these avenues promote liquidity, investor participation, and sustainable compliance. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, reinforces the dematerialization requirements for buybacks and delisting to enhance operational efficiency and investor protection. In accordance with Regulation 40 and related provisions, shareholders intending to participate in buyback or delisting processes must hold securities in dematerialized (DMAT) form, thereby eliminating the risks associated with physical share certificates. Entities undertaking such corporate actions are required to ensure that only DMAT holdings are accepted, compelling investors to convert physical securities prior to tendering. This measure promotes transparency, reduces fraud, expedites settlement cycles, and aligns India's capital market infrastructure with technology-driven governance and global best practices. Slide 3. Minimum Public Shareholding (MPS) enforcement and its monitoring process. The Minimum Public Shareholding (MPS) enforcement framework under the SEBI Master Circular on LODR compliance, dated the 30th of January 2026, establishes a robust regulatory mechanism to ensure that listed entities maintain the prescribed 25% public shareholding on a continuous basis. The enforcement regime is designed to promote market liquidity, transparency, and equitable participation of public investors while deterring prolonged non-compliance. Stock exchanges play a central role in monitoring adherence and initiating progressive penal measures against defaulting entities. In cases of initial non-compliance, SEBI has prescribed structured and time-bound enforcement actions. These include the imposition of monetary penalties of 5,000 rupees per day, freezing of promoter and promoter group shareholding, and restrictions on the exercise of voting rights. Additionally, promoters and directors may face limitations on corporate benefits and governance privileges until compliance is restored. These measures are intended to incentivize timely corrective action while safeguarding investor interests. If non-compliance persists beyond 1 year, the regulatory response becomes more stringent. Penalties may increase to 10,000 rupees per day, and further restrictions such as freezing of promoter DMAT accounts and continuation of debarment measures may be imposed. Persistent violations may also attract additional regulatory scrutiny and enforcement proceedings. The monitoring process involves periodic verification of shareholding patterns, quarterly reporting to stock exchanges, and continuous surveillance through technology-enabled systems. Exchanges assess compliance status, issue reminders, and escalate enforcement where necessary. This structured and progressive framework strengthens accountability, ensures disciplined market conduct, and aligns Indian capital market practices with global standards of corporate governance and investor protection. Slide 4. Open market sale requirements and commodity risk disclosures. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes detailed open market sale requirements to ensure transparency, fairness, and orderly dilution when promoters reduce their shareholding to achieve minimum public shareholding (MPS) norms. These provisions mandate strict adherence to disclosure and procedural safeguards in order to protect investor interests and maintain market stability. Promoters are required to make pre-sale disclosures, including advance intimation of their intent, quantity of shares proposed to be sold, and the indicative timeline. Such disclosures must be communicated to stock exchanges and the public in a timely manner to enable informed decision-making. Further, trading restrictions are imposed to prevent market disruption and misuse of insider information. Promoters must not undertake transactions in company securities on days when open market sales are executed for MPS compliance. This ensures market integrity and avoids conflicts of interest. Additionally, regulatory compliance with broader securities laws, including insider trading and takeover regulations, is mandatory. The circular also stipulates limits on open market sales, generally permitting dilution of up to 2% annually or 5% cumulatively, thereby facilitating gradual and orderly compliance while preserving price stability. In parallel, the circular strengthens commodity risk disclosures under Regulation 34 and Schedule 5, requiring listed entities to provide comprehensive information on exposure to commodity price risks. Companies must undertake systematic risk identification and assessment, evaluating the impact of price fluctuations on operations and financial performance. The framework further mandates disclosure of hedging strategies, including instruments used, risk mitigation policies, and governance oversight. Entities are also required to present annual reporting on commodity risk exposure and mitigation measures in the annual report. Collectively, these provisions enhance transparency, support risk-informed decision-making, and align corporate disclosures with global best practices in financial risk management and sustainable governance. Slide 5. E-voting, support infrastructure and facility for shareholders. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, emphasizes a robust e-voting support infrastructure to ensure seamless, secure, and inclusive shareholder participation. This framework integrates depositories, intermediaries, and technology service providers to facilitate efficient electronic voting processes. Depositories are mandated to issue alerts to shareholders at least 2 to 3 days prior to the commencement of the e-voting window, thereby enhancing awareness and preparedness. These alerts include voting timelines, procedural guidance, and secure access credentials. Further, the infrastructure requires the establishment of dedicated technical support mechanisms, including help desks, online portals, and grievance redressal channels to address login, authentication, and operational challenges. Listed entities must also ensure adequate dissemination of notices, explanatory statements, and relevant disclosures through digital platforms to promote informed decision-making. Accessibility is a key priority, with user-friendly interfaces, mobile compatibility, and facilitation measures for physical and institutional shareholders. Collectively, this structured support ecosystem strengthens transparency, investor engagement, and confidence in digital governance practices. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, mandates a structured and secure e-voting facility for shareholders, enabling wider and more effective participation in corporate governance. In accordance with Regulation 44, listed entities must provide multiple access channels to ensure convenience, inclusivity, and data security. Under the direct registration mechanism, shareholders may register on the designated e-voting platform using their registered mobile number or email address, followed by one-time password, OTP, verification, thereby ensuring authenticated and secure access. This route is particularly beneficial for investors who may not regularly access depository portals. Further, shareholders may cast their votes through depository participants, DPs, wherein secure access is provided via authenticated login on DP websites. This method enhances reliability and promotes seamless integration with existing demat services. Additionally, the facility allows voting through demat accounts, enabling investors to access ESD or ESP portals directly using demat credentials. Collectively, these three-tier mechanisms strengthen accessibility, improve participation rates, and reinforce transparency, accountability, and investor confidence in the digital corporate governance framework. Slide 6. Board Evaluation Framework. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, reinforces the importance of a structured board evaluation framework in alignment with the Companies Act, 2013 and Regulation 17 of the LODR regulations. The guidance aims to enhance governance standards by ensuring periodic and comprehensive assessment of the performance of the board, individual directors, and key committees, thereby strengthening accountability, transparency, and strategic effectiveness. The evaluation process begins with the identification of the subject of evaluation, which typically includes the overall board, independent directors, executive and non-executive directors, as well as specialized committees such as audit and nomination committees. This ensures a holistic review covering governance, oversight, and stakeholder engagement. The second key aspect is the design of the evaluation process, which may involve structured questionnaires, peer reviews, and self-assessment mechanisms. Companies are encouraged to adopt objective methodologies, engage external experts where appropriate, and ensure confidentiality to promote candid participation. The framework further emphasizes well-defined evaluation criteria, including leadership, strategic guidance, risk oversight, ethical conduct, succession planning, and effectiveness in decision-making. These parameters facilitate measurable and comparable outcomes. Finally, feedback and follow-up are critical components. The board must review the findings, identify gaps, and implement action plans within specified timelines, such as annual evaluation cycles. This continuous improvement approach fosters robust governance, aligns organizational performance with stakeholder expectations, and supports sustainable long-term value creation. Slide 7. Stock Exchange Arbitration Mechanism. The SEBI Master Circular on LODR Compliance, dated the 30th of January 2026, reinforces the stock exchange arbitration mechanism under Regulation 40, providing a structured and time-bound dispute resolution framework between listed entities and their shareholders or investors. This mechanism strengthens investor confidence by ensuring efficient, transparent, and cost-effective redressal of grievances within the securities market ecosystem. The scope of disputes covered under this framework is comprehensive and includes issues relating to transfer and transmission of securities, dematerialization and rematerialization processes, corporate actions such as dividends, bonus shares, rights entitlements, and interest payments. It also extends to delays, operational deficiencies, or procedural lapses in servicing investor requests. By encompassing these critical areas, the mechanism seeks to ensure protection of investor rights and promote fair market practices. The framework mandates the establishment of standard operating procedures, SOPs, by stock exchanges, with most exchanges having implemented detailed guidelines since June 1, 2020, for arbitration of investor grievances. These SOPs outline timelines, documentation standards, eligibility criteria, and escalation mechanisms to ensure uniformity and procedural clarity. The SOPs are made publicly accessible on stock exchange websites, thereby enhancing transparency and accountability. Further, registrar and transfer agents, RTAs, play a pivotal role in this mechanism. RTAs are required to register and trace transfer requests, maintain records, and represent listed entities during arbitration proceedings. Their involvement ensures operational accuracy, timely resolution, and alignment with regulatory expectations, thereby strengthening the overall dispute resolution framework. Slide 8. Grievance Resolution and Corporate Governance Recommendations. The SEBI Master Circular on LODR Compliance, dated the 30th of January 2026, recognizes the growing significance of grievance resolution with proxy advisors in strengthening investor protection and corporate governance. Proxy advisory firms play a pivotal role in assisting institutional and retail investors by providing independent research, voting recommendations, and governance insights. Acting as an intermediary between listed entities and shareholders, they help identify governance concerns, promote transparency, and facilitate informed decision-making. The resolution mechanism mandates that listed entities maintain an effective and time-bound framework to address grievances raised by proxy advisors. In instances of non-compliance or governance lapses, SEBI may initiate enforcement under the SEBI Research Analysts regulations, ensuring adherence to prescribed standards. Listed entities are also required to engage constructively, provide clarifications, and adopt corrective measures within defined timelines. This structured approach enhances accountability, reduces conflicts, and promotes responsible stewardship, thereby aligning corporate practices with evolving global governance expectations. The SEBI incorporates key corporate governance recommendations arising from the Uday Kotak Committee, particularly focusing on group governance units and strategy disclosure to strengthen oversight and transparency. Listed entities with complex structures, including those having multiple subsidiaries or joint ventures, are encouraged to establish a dedicated group governance unit. This unit is responsible for monitoring governance practices, risk management, compliance alignment, and ethical conduct across the group, thereby ensuring consistency and accountability at all levels. Further, the framework emphasizes enhanced strategy disclosure, requiring companies to articulate their medium-term and long-term strategic objectives in the management discussion and analysis section of the annual report. Entities are expected to disclose measurable performance indicators, progress benchmarks, and value creation initiatives. This approach promotes informed investor engagement, improves accountability, and aligns corporate strategy with sustainable growth and stakeholder expectations. Slide 9. Position requirement for compliance officer. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes structured position requirements for the compliance officer to ensure effective regulatory oversight and accountability. At the organizational level, the compliance officer is required to be a senior executive, positioned one level below the managing director or whole-time directors who are part of the board. This placement ensures adequate authority, independence, and access to critical information for monitoring compliance with securities laws. Under the alternative structure, in cases where a company does not have a chief executive officer or managing director, the compliance officer may be positioned below a senior executive such as the chief managerial officer or an individual heading day-to-day operations. This flexibility enables continuity in governance while maintaining regulatory intent. Further, the role mandates key managerial personnel (KMP) designation in accordance with the Companies Act, 2013, thereby reinforcing responsibility, accountability, and alignment with corporate governance and disclosure standards. Slide 10. Integrated Filing Framework and Quarterly Material Event Disclosure. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, introduces an integrated filing framework to streamline disclosures, enhance efficiency, and reduce compliance duplication for listed entities. The framework categorizes filings into integrated filing, governance, and integrated filing, financial, ensuring a structured and time-bound reporting mechanism. Under integrated filing, governance, companies are required to submit key governance-related disclosures within 30 days from the end of each quarter. These include statements on investor grievance redressal, corporate governance compliance, and quarterly material events. This consolidated approach promotes uniformity, transparency, and timely communication with stakeholders. The integrated filing, financial, segment mandates submission within 45 days from the close of the quarter, covering related party transaction disclosures, statements of deviation or variation, and quarterly financial results. By integrating governance and financial reporting, SEBI aims to strengthen accountability, improve comparability, and align Indian disclosure practices with global regulatory standards. The SEBI mandates quarterly material events disclosure to strengthen transparency and ensure timely dissemination of critical developments to investors. Listed entities are required to disclose, on a quarterly basis, significant shareholding acquisitions, including purchase or sale of shares or voting rights in listed or unlisted entities, particularly where such transactions exceed prescribed thresholds or influence control and strategic positioning. Further, companies must report fines and penalties imposed by regulatory, statutory, or judicial authorities, including the monetary impact and nature of non-compliance. This enables stakeholders to assess governance standards and risk exposure. Additionally, the framework requires periodic updates on tax litigations, including ongoing disputes, contingent liabilities, and material developments. Such structured disclosures enhance accountability, facilitate informed investment decisions, and align corporate reporting with evolving global governance and risk management practices. Slide 11. Employee Benefit Scheme Disclosure Guidelines. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes enhanced employee benefit scheme disclosure guidelines under Regulation 46 to ensure transparency, investor protection, and alignment with sound corporate governance practices. Listed entities are required to upload all material documents relating to employee benefit schemes, such as employee stock option plans, ESOPs, employee stock purchase schemes, ESPS, and stock appreciation rights, SARs, on their official websites, while excluding commercially sensitive or confidential information. The framework begins with shareholder approval, mandating that listed entities obtain the requisite consent in accordance with the SEBI, Share-Based Employee Benefits and Sweat Equity, Regulations, 2021 before implementing or modifying such schemes. Following approval, companies must upload the scheme documents in a timely manner, thereby ensuring accessibility and transparency for investors and stakeholders. Further, the guidelines specify minimum information requirements, including details of eligibility, vesting schedules, exercise price, performance conditions, and dilution impact. This ensures that shareholders are provided with comprehensive and comparable disclosures. In cases where certain information requires confidentiality, redaction approval must be obtained from the board, supported by a documented rationale and assessment of competitive sensitivity. Finally, a compliance confirmation is required through certification in the Secretarial Compliance Report, affirming adherence to disclosure norms. Collectively, these structured and four-step requirements strengthen accountability, foster trust, and align employee incentive frameworks with long-term value creation. Slide 12. Secretarial Auditor Requirements and Single Filing System strengthens the framework governing secretarial auditor requirements to ensure high standards of professional competence, independence, and regulatory oversight. In accordance with Regulation 24A, listed entities are required to appoint a peer-reviewed company secretary in practice as the secretarial auditor, thereby enhancing the credibility and reliability of compliance reporting. This eligibility criterion ensures that only qualified professionals, meeting specified peer review standards, undertake the audit of secretarial and governance practices. The circular also prescribes defined service restrictions to maintain auditor independence and prevent conflicts of interest. Secretarial auditors may provide only those additional services that are duly approved by the board or audit committee and are not prohibited under SEBI regulations. These safeguards aim to strengthen objectivity, professional integrity, and transparency in the audit process. Collectively, these provisions reinforce accountability, improve the quality of compliance assurance, and align secretarial audit practices with evolving global standards of corporate governance and regulatory discipline. The SEBI introduces a single filing system and system-driven disclosures framework to enhance efficiency, accuracy, and regulatory coordination in corporate reporting. Under the single filing system, listed entities are required to submit key compliance and governance information through a unified digital platform, thereby eliminating duplication across stock exchanges and regulatory authorities. The implementation, initiated in a phased manner from October 1, 2024, covers disclosures such as corporate governance reports, share capital audit reports, and voting results. This integrated approach reduces administrative burden, promotes consistency, and ensures timely dissemination of information. The system-driven disclosures mechanism further leverages technology by enabling stock exchanges, in coordination with SEBI, to automatically generate and disseminate certain disclosures based on validated data. This includes updates on shareholding patterns and newly revised credit ratings. By minimizing manual intervention, the framework enhances data integrity, improves regulatory monitoring, and aligns disclosure practices with global standards of digital governance and transparency. Slide 13. Master Circular Updates and Compliance. The SEBI Master Circular on LODR Compliance, dated the 30th of January 2026, introduces significant updates to strengthen compliance, governance, and ease of doing business for listed entities. These revisions reflect the recommendations of expert committees and aim to streamline disclosure practices while enhancing regulatory clarity and accountability. The circular consolidates various reporting requirements and prescribes standardized formats to ensure consistency and comparability across the market ecosystem. A key update relates to format consolidation, whereby disclosures such as corporate governance reports, financial results, statements of deviation or variation, and related party transaction formats have been integrated into unified reporting structures. This reduces duplication, improves efficiency, and supports a more structured compliance environment. The circular also introduces a structured reclassification and penalties framework, particularly in cases of non-compliance, including delays in promoter or promoter group reclassification as public shareholders. Defined timelines and progressive enforcement measures aim to promote timely adherence and strengthen regulatory discipline. Further, enhanced provisions for group governance units provide clearer implementation guidance for monitoring subsidiaries and ensuring alignment of governance practices across complex corporate structures. In addition, revised timelines for material event disclosures, including quarterly reporting cycles, improve transparency and investor communication. Overall, these updates reinforce accountability, technological integration, and alignment with global governance and disclosure standards. Slide 14. Penal actions for non-compliance. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes a structured framework of penal actions for non-compliance to ensure strict adherence to regulatory obligations. The enforcement mechanism includes a uniform fine structure, imposing monetary penalties based on the nature, duration, and severity of non-compliance. In cases of persistent default, SEBI and stock exchanges may initiate freezing of promoter and promoter group shareholding, restricting transfer and voting rights to safeguard investor interests. Further, continued violations may attract trading suspension of specified securities, along with defined operating procedures for suspension and revocation. These progressive and time-bound measures strengthen accountability, deter regulatory breaches, and promote a culture of proactive compliance, transparency, and responsible corporate governance across listed entities. The SEBI establishes a comprehensive regulatory framework and authority to ensure consistent enforcement and effective supervision of listed entities. SEBI exercises its regulatory powers under the Securities and Exchange Board of India Act, 1992 and the Securities Contracts, Regulation, Act, 1956, thereby providing a structured and legally robust compliance environment. A key component of this framework is the uniform enforcement structure, which standardizes penalties, disclosure requirements, and monitoring mechanisms across all stock exchanges. This harmonized approach promotes transparency, predictability, and regulatory consistency for listed companies. Further, in cases of persistent non-compliance, SEBI may initiate promoter and promoter group shareholding freezing, restricting transfer, pledge, or exercise of voting rights. Such measures are designed to ensure accountability and compel timely corrective action. Additionally, the framework provides for trading suspension of securities as a last resort where violations continue beyond prescribed timelines. These calibrated and progressive actions reinforce investor protection, strengthen market discipline, and uphold the integrity of the securities market. Slide 15. Stock Exchange Responsibilities. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, delineates comprehensive stock exchange responsibilities to ensure effective monitoring, enforcement, and transparency in the securities market. Stock exchanges are mandated to take timely and appropriate action in cases of non-compliance with LODR provisions, including the implementation of standard operating procedures for suspension and revocation of trading. They are also empowered to delay enforcement in exceptional circumstances, considering the interests of investors and overall market stability. Among the key requirements, exchanges must ensure uniform enforcement of regulatory provisions, coordinate with depositories for freezing or unfreezing promoter shareholding, and share critical information across exchanges to maintain consistency. They are further required to disclose enforcement actions, including fines, suspension, and promoter freezing measures, on their official websites on a quarterly basis. Additionally, stock exchanges must maintain transparency by publishing regulatory disclosures, imposed penalties, and shareholding-related actions, thereby strengthening investor confidence, enhancing accountability, and promoting disciplined compliance across listed entities. Slide 16. Non-compliance penalties and additional penalty categories. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes a structured and progressive framework of non-compliance penalties to ensure strict adherence to governance, disclosure, and reporting obligations. The regulatory mechanism specifies fines for key violations, thereby promoting accountability and timely compliance. For instance, non-compliance relating to board composition requirements, including failure to appoint independent or women directors, attracts penalties of 5,000 rupees per day until rectification. Similarly, delays in submission of financial results within prescribed timelines under Regulation 33 may result in fines of 5,000 rupees per day. Non-compliance with Audit Committee Constitution under Regulation 18 also attracts comparable monetary penalties, while delays in disclosure of shareholding patterns may lead to fines of 2,000 rupees per day. In addition, the framework categorizes additional penalty categories to address specific governance lapses. Under per instance violations, penalties include 1,000 rupees per instance for board meetings not held as required and 50,000 rupees per instance for non-compliance with key governance provisions. For daily accrual violations, delays in compliance with provisions such as investor complaints or corporate announcements may attract fines of 1,000 rupees per day, with higher penalties such as 2,000 rupees per day for significant defaults. Further, committee-related violations, including non-constitution of nomination, stakeholder, or risk management committees, may attract penalties ranging from 2,000 rupees to 3,000 rupees per day. Collectively, this calibrated penalty regime reinforces transparency, deters non-compliance, and strengthens corporate governance standards across listed entities. Slide 17, Enforcement Timeline and Process. The SEBI Master Circular on LODR Compliance, dated the 30th of January 2026, establishes a structured enforcement timeline and process to ensure timely rectification of regulatory violations and strengthen accountability. The process begins with a review of compliance by stock exchanges, typically conducted within 30 days of identifying a default or irregularity. This initial assessment evaluates the nature, duration, and materiality of non-compliance. Subsequently, a notice is issued to the listed entity, providing a defined opportunity to respond, clarify, or undertake corrective action within the prescribed time frame. If the default persists, a separate notice may be issued to promoters, allowing them an additional period, often 15 days, to ensure compliance and restore regulatory adherence. In cases of continued non-compliance, exchanges may initiate freezing of promoter and promoter group shareholding, restricting transfer and voting rights. This progressive and time-bound enforcement mechanism promotes discipline, ensures transparency, and protects investor interests while enabling a fair and proportionate regulatory response. Slide 18, Standard Operating Procedure for Suspension. The SEBI Master Circular on LODR Compliance, dated the 30th of January 2026, prescribes a comprehensive Standard Operating Procedure, SOP, for suspension to ensure uniform enforcement across stock exchanges and protect investor interests. The process begins with the Z category movement, wherein non-compliant securities are shifted to the trade for trade segment, accompanied by a 7-day prior notice to the listed entity and a 10-day public intimation. This step serves as an early warning and promotes timely corrective action. If compliance is not restored, the suspension notice stage follows, involving a 21-day prior intimation to the entity and a 30-day public notice before actual suspension. Continued default leads to trading suspension, with promoter and promoter group shareholding remaining frozen until rectification. Further, after 35 days, limited trading under the trade for trade basis may be permitted for a defined period of 6 months, allowing exit opportunities for investors. This structured and phased approach balances enforcement with investor protection and market stability. Slide 19, Promoter Shareholding Freeze. The SEBI Master Circular on LODR Compliance, dated the 30th of January 2026, prescribes a structured and time-bound framework for promoter shareholding freeze to address persistent non-compliance and safeguard investor interests. The process is initiated when the notice period expires, and the listed entity fails to rectify the default or pay the applicable fines within the prescribed timelines. Subsequently, the stock exchange intimates the depositories, directing them to initiate enforcement action. Upon such communication, immediate freezing of promoter and promoter group shareholding is carried out, covering all securities held in dematerialized accounts. This restriction prevents transfer, pledge, or disposal of shares, thereby ensuring regulatory discipline and compelling corrective action. Further, formal notification is issued to promoters, informing them of the freeze and the conditions for restoration. The freeze remains effective until the entity fully complies with regulatory requirements and clears outstanding dues. Upon compliance, the unfreezing of securities occurs promptly, reinforcing accountability, transparency, and adherence to corporate governance standards within the securities market. Slide 20. Suspension criteria and its revocation procedure. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, prescribes clear suspension criteria for 2 consecutive quarters to ensure timely compliance and protect market integrity. Trading in specified securities may be suspended if a listed entity fails to adhere to key regulatory obligations for 2 successive quarters, particularly those relating to corporate governance, disclosure, and financial reporting. This structured approach promotes discipline, transparency, and accountability across the capital market ecosystem. The suspension framework covers multiple critical compliance areas. These include failure to meet board composition requirements, such as the appointment of independent and women directors in accordance with Regulation 17. Non-compliance with the constitution of the Audit Committee under Regulation 18 is also considered a serious governance lapse. Further, delays or omissions in submission of the corporate governance report under Regulation 27, as well as failure to disclose shareholding patterns on a quarterly basis under Regulation 31, may trigger enforcement action. In addition, non-submission of financial results within prescribed timelines under Regulation 33 and failure to publish the annual report for 2 consecutive financial years under Regulation 34 constitute material defaults. Persistent non-compliance across these areas for 2 consecutive quarters may result in trading suspension, reinforcing investor protection and ensuring adherence to regulatory standards and global governance practices. The SEBI prescribes a structured suspension revocation procedure to facilitate the orderly restoration of trading once a listed entity achieves compliance. The process begins when the company fulfills all outstanding regulatory requirements and submits necessary disclosures, financial results, and governance reports within the prescribed timelines. Upon verification of compliance, the stock exchange initiates the revocation process, which includes issuing a public notice informing investors and stakeholders of the proposed restoration of trading. This ensures transparency and adequate market awareness. Subsequently, a defined 7-day notice period is provided before trading is resumed. In certain cases, trading may initially be permitted under the Trade for Trade segment for 7 days, allowing restricted and monitored transactions to safeguard investor interests and prevent volatility. Thereafter, securities are shifted to normal trading once market stability is ensured. However, if the entity fails to achieve compliance within 6 months from the date of suspension, exchanges may consider compulsory delisting, reinforcing regulatory discipline and market integrity. Slide 21. Board accountability requirements and fine allocation and investor protection. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, strengthens board accountability requirements to ensure heightened oversight and responsibility in cases of regulatory non-compliance. Stock exchanges are mandated to direct non-compliant listed entities to place the matter, along with corrective actions, before the board of directors at the next scheduled meeting. This ensures that governance lapses receive strategic attention and timely resolution at the highest decision-making level. The framework also requires board comments and recommendations on the causes of non-compliance, remedial measures, and future preventive strategies. Such structured evaluation enhances accountability and promotes a culture of proactive compliance. Further, exchanges must obtain confirmation that the board has reviewed the issue and initiated corrective action. In addition, exchange notification is required, whereby the board's decisions and progress updates must be communicated to stock exchanges for public dissemination. This transparent and time-bound approach reinforces governance standards, strengthens stakeholder confidence, and aligns corporate conduct with evolving global best practices in accountability and disclosure. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, establishes a robust framework for fine allocation and investor protection to ensure that enforcement actions directly support market integrity and stakeholder confidence. Under this mechanism, 100% of fines collected from non-compliant listed entities are credited to the Investor Protection Fund (IPF) of the concerned stock exchange. This approach ensures that regulatory penalties are utilized exclusively for investor education, awareness programs, and protection initiatives, thereby reinforcing the investor-centric philosophy of the securities market. Further, stock exchanges are required to undertake periodic monitoring and review of compliance status within 30 days, ensuring timely corrective action and transparency in enforcement. In addition, exchanges must provide quarterly disclosures, at least 90 days apart, detailing the names of defaulting entities, nature of violations, fines imposed, freezing actions, and subsequent compliance updates. This structured and transparent allocation framework enhances accountability, strengthens investor confidence, and promotes disciplined compliance while aligning regulatory enforcement with long-term market development and global governance standards. Slide 22. Key takeaways, Enforcement Framework. The SEBI Master Circular on LODR compliance, dated the 30th of January 2026, highlights the key takeaways of the enforcement framework, reflecting a structured, transparent, and investor-centric regulatory approach. A core element of the framework is the introduction of structured penalties, wherein stock exchanges impose uniform fines on a daily accrual basis until non-compliance is rectified. This ensures consistency in enforcement across all listed entities and promotes timely corrective action. Another significant takeaway is enhanced promoter accountability. In cases of persistent default, exchanges may initiate freezing of promoter and promoter group shareholding, restricting transfer and voting rights. This mechanism places direct responsibility on promoters and reinforces governance discipline. The framework also emphasizes progressive enforcement, providing for escalating regulatory actions. These include monetary fines, freezing measures, trading suspension after defined timelines such as 2 consecutive quarters of non-compliance, and ultimately compulsory delisting in cases of continued default. Such a calibrated approach balances deterrence with opportunities for remediation. Further, investor protection remains central, with 100% of fines credited to the Investor Protection Fund and periodic disclosures made on a quarterly basis. Collectively, these measures strengthen transparency, accountability, and market integrity while aligning India's enforcement practices with global regulatory standards. This brings us to the conclusion to the 3-episode series of the SEBI Master Circular on LODR compliance for annual disclosures, secretarial audit and sustainability reporting and other obligations and disclosures requirements that hold significant importance in strengthening corporate governance by consolidating diverse regulatory provisions into a comprehensive and coherent framework. It promotes transparency, accountability, and timely disclosures, thereby enhancing investor confidence and market integrity. The circular introduces uniform compliance standards, structured enforcement mechanisms, and technology-driven reporting, which improve regulatory efficiency and reduce ambiguity. By emphasizing board responsibility, stakeholder engagement, risk management, and sustainability disclosures, it aligns governance practices with global benchmarks. Overall, the Master Circular fosters ethical conduct, proactive compliance, and long-term value creation, contributing to a resilient, transparent, and well-regulated capital market ecosystem in India. We encourage you to remain connected with our channel, actively engage with the content, and share these insights within your professional networks. Your continued support and recognition, through subscribing and enabling notifications, are deeply appreciated. We extend our sincere gratitude for your sustained engagement and participation. We wish all our viewers continued success, along with a happy, healthy, and prosperous journey ahead. Until we meet again, thank you and goodbye for now.